Chapter 1 Learning Objective 4 is to understand cost behavior patterns, including variable costs, fixed costs, and mixed costs. In practice, it's necessary to predict how a certain cost will behave in response to a change in activity. For example, a manager may want to know if sales increase 5%, what's the impact on the utility bill? Here, cost behavior refers to how cost will react to changes in the level of activity. And there are three classifications: variable costs, fixed costs, and mixed costs. Variable cost. Variable cost variance in direct proportion to changes in the level of activity. Examples are cost of goods sold, direct material, direct labor. These costs will change in response to change in the level of activity. For cost to be variable, it must be variable with respect to something. The something is activity base, or cost driver. The activity base is a measure of what causes the incurrence of a variable cost. The activity base or cost driver could be units produced, machine hours, miles driven, or labor hours. In the textbook, we will assume the activity base is the total volume of goods and services provided by the company. Let's take a look at an example here. Let's say if you don't have an unlimited plan on your cell phone, for each messaging, it costs 5 cents. Then your total texting bill is based on how many texts you send. If you take a look at the graph here, more texts sent, the higher texting bill. However, if we take a look at the variable cost per unit, the cost per text sent is constant, 5 cents for each text message. Fixed cost. Fixed cost is constant regardless of the level of activity. Let's say your monthly contract fee for a cell phone is fixed for a number of monthly minutes in your contract. Then, your monthly contract fee does not change based on the number of calls you make, as long as you do not call over minutes. But if we take a look at the fixed cost per unit, the average fixed cost per cell phone call made goes down as more calls are made. For fixed costs, there are two types: committed and discretionary. Committed fixed costs are long-term, cannot be significantly reduced in the short term. Examples here include depreciation on buildings and equipment and real estate taxes. For discretionary fixed costs, they can be changed in the short term by current managerial decisions. Examples here are advertising and R&D costs. Please note here, a cost may be committed or discretionary, depending on management strategy. For example, some construction companies may lay off workers during months with minimum customer demand. However, other construction companies may keep their workers all year. So it really depends on the management strategy. Mixed costs, or semi-variable cost. A mixed cost contains both variable and fixed components. Let's take a look at an example of a utility cost. This graph describes the mixed cost of a normal utility bill. A utility bill contains a fixed and a variable cost component. The fixed portion of a utility bill is constant, regardless of a kilowatt hours consumed. This cost represents the minimum cost which incurred to have the service ready and available for use. The variable portion of a utility bill varies in direct proportion to the use of kilowatt hours. The mixed cost can be expressed as the equation y equals a plus bx. Here, y is the total mixed cost. A is the total fixed cost. That's a vertical intercept of a line. B is the variable cost per unit of activity. Here, that's a variable cost per kilowatt. Slope of the line. And X is the lower activity, the use of kilowatt hours. So to get mixed cost, as long as we know A, B, and level of activity, and we can calculate using this equation, y equals a plus bx. Let's take a look at the calculation example. If your fixed monthly utility charge is $40, your variable cost is 3 cents per kilowatt hour, and your monthly activity level is 2,000 kilowatt hours. What's the amount of your utility bill? Based on the equation here, y equals a plus bx. A is $40 plus bx, 3 cents multiplied by 2,000. And we get y, that's the total mixed cost of your utility bill, $100. Management accountants normally assume costs are strictly linear, which means the relation between cost on one hand and activity on the other can be represented by the straight line within relevant range. Relevant range here is a range of activity within which the assumption that cost behavior is strictly linear is reasonable and valid. But economists point out many costs which accountants classify as variable costs actually behave in a curvilinear fashion. Currently in accounting, within relevant range, we use a straight line to approximate a curvilinear variable cost line. Fixed cost and relevant range. Let's take a look at the example here. Assume office space is available at a rental rate of $30,000 per year in increments of 1,000 square feet. Fixed costs would increase in a step fashion at a rate of $30,000 for each additional 1,000 square feet. If we draw the graph here, within relevant range, fixed costs increase in a step fashion at a rate of $30,000 for each additional increase of 1,000 square feet. This is a summary of the cost behavior for variable and fixed costs. So you can see for variable cost, total variable cost increase and decrease in proportion to changes in the activity level. But in terms of per unit variable cost per unit remains constant. For fixed cost, the total fixed cost is not affected by changes in the activity level within the relevant range. It's constant. But per unit fixed cost decreases as the activity level goes up and increases as the activity level goes down. Learning Objective 5. Understand cost classifications used in making decisions, relevant costs and irrelevant costs. It's important to realize every decision involves a choice between at least two alternatives. The goal of making decision is to identify those costs which are either relevant or irrelevant to the decision. Costs and benefits which differ between alternatives are relevant in the decision, but all other costs and benefits are irrelevant and should be ignored. To make a decision, we need to know three classifications: differential costs, opportunity costs, and sunk costs. Differential cost and revenue. Differential cost is the difference in cost between any two alternatives. Differential cost can be either fixed or variable. Differential revenue is the difference in revenue between two alternatives. For example, if you have a job paying $1,500 per month in your hometown, and you have a job offer in a neighborhood city which pays $2,000 per month, but the commuting cost to the city is $300 per month, we can calculate the differential revenue and differential cost. Differential revenue is the difference in revenue. $2,000, that's a job offer in a neighborhood city. And $1,500, this is the salary for the current job. So the difference here is the differential revenue, $500. The commuting cost to the city, $300. This is differential cost. Sunk costs. Sunk costs are those costs which have already been incurred and cannot be changed now or in the future. When we make decisions, these costs should be ignored. They are irrelevant. You've already paid your summer session tuition. So whether you come to the class or watch a video, you should not consider tuition paid as relevant to make your decision, because you already paid. They're sunk costs. Opportunity cost. The opportunity cost is a potential benefit which is given up when one alternative is selected over another. For example, if you are not attending college, you could be earning $15,000 per year. Your opportunity cost of attending college for 1 year is $15,000. In summary, for different purposes, we can classify costs into different classifications. For the purpose of assigning costs to cost objects, we can classify costs into direct costs and indirect costs. For the purpose of accounting for costs in manufacturing companies, we can classify costs as manufacturing costs and non-manufacturing costs. Manufacturing costs include direct materials, direct labor, and manufacturing overhead. Non-manufacturing costs include selling and administrative costs. For the purpose of preparing financial statements, we can classify costs as product costs and period costs. Manufacturing costs are product costs. Non-manufacturing costs, selling, and administrative costs are period costs. Product costs will be recognized as assets in the beginning, and when products are sold, product costs will be transferred into expenses. Period costs will be expensed immediately. For the purpose of predicting cost behavior in response to changes in activity, there are 3 classifications: variable, fixed, and mixed cost. Variable cost varies in direct proportion to level of activity, but variable cost per unit is constant. Fixed cost is constant, but fixed cost unit will decrease as the level of activity increases. Mixed cost includes both variable and fixed components. When making decisions, we should only consider relevant costs, but ignore irrelevant costs.